Welcome to the deep dive. Today, we're diving straight into a financial document that might sound a bit intimidating, the balance sheet,
Right.
but it's actually your quick ticket to understanding a company's financial health. Think of this as, equipping yourself with the essentials to see what's really going on under the hood.
And we're drawing on some great insights here from balancesheet.pdf by Accounting Botcast. It's more than just a dry run-through of US GAAP and SEC rules.
Definitely.
It gives you practical perspectives, helps you understand not just the rules, but why they matter in the real world.
Exactly. Our mission here really is to give you a clear grasp of the balance sheet's purpose, its key parts. We want to break it down so you feel confident, without drowning in jargon. You'll sometimes hear it called the statement of financial position. It seems a bit formal, maybe, but we'll stick with the common term. Balance sheet.
Sounds good.
Okay, let's get into this.
So the balance sheet, it's a basic financial statement.
Yeah.
Public companies, private companies, they all use it.
Right.
And what's kind of fascinating is how simple the core idea is. It's just a snapshot. What a company owns assets, what it owes liabilities.
And the owner's stake?
And the owner's stake, equity, all captured at one specific moment in time. Like you said, a financial photograph.
A photograph? Exactly. And today, we're going to look at the general rules for presenting this photo, walk through an example so you can see it laid out.
Right.
And touch on important ideas like offsetting, non-controlling interests, and even some things specific to private companies.
Yeah, good plan. So the main rule books we're dealing with are ASC 205, that's presentation of financial statements generally, and ASC 210, which zooms in on the balance sheet itself.
Okay.
And what's interesting is how closely these accounting standards, GAAP, align with SEC regulations, though the SEC, well, they often pile on a few extra requirements, especially for public companies.
Ah, yeah, the public company angle. That's where it gets interesting, right? For those commercial and industrial ones registered with the SEC, you hear about SX Article 5 a lot.
You do.
Think of that as the SEC's detailed instruction manual for the balance sheet presentation.
Pretty much.
Then there's SAB Topic 11, now tucked into ASC 205, you said. That guides consistency over time.
Correct. Chronological ordering, making sure things look the same from filing to filing.
And Articles 3 and 4 of Regulation SX. Article 3 is the one requiring those 2 years of balance sheets side by side. Makes comparisons easier.
Exactly. That comparative view is key. And Article 4 gives the overall structure, the form and order for the financial statements. So yeah, lots of specific SEC rules depending on who you are.
But it's not one size fits all, is it? You mentioned Article 5 requires a classified balance sheet.
Right. We'll get into what classified means.
But other types of companies might follow different SEC articles, like investment or insurance companies.
Precisely. They might fall under Article 6 or 7, and their balance sheet rules could look a bit different. So always good to know which playbook a company is using.
Good point. Now, this guide, we're referencing it as a sample balance sheet, figure FSP 21. It shows that classified type under SX 502. And I thought the font thing was clever. Bold for the strictly required SEC captions, regular font for GAAP, or just typical stuff.
Yeah, that's helpful. It sort of flags what's non-negotiable versus what's standard practice or optional.
Right.
And you got to remember, looking at this sample, a real company's balance sheet will vary. It depends on their business. Some of those bold SEC lines might not even apply to them.
Sure.
But the sample covers the main sections. Assets first. You've got current assets, cash, marketable securities, receivables, inventory, basically stuff they expect to use return into cash within about a year.
Or their operating cycle.
Or their operating cycle, yes. Then non-current assets, longer-term things, debt and equity securities they plan to hold, property, plant, equipment, intangibles like patents, goodwill.
Okay, makes sense. Then the other liabilities. Current ones are debts due soon, yeah. Like accounts payable to suppliers, bit of long-term debt due this year, taxes payable.
Exactly. Obligations expected to be settled within that same year or operating cycle. And non-current liabilities are the longer-term obligations. Bonds, debt due further out, deferred tax liabilities.
Deferred taxes.
Yeah.
Those always seem a bit tricky.
Yeah, they represent future tax payments, not immediate cash out. We can touch on that.
Okay. And the final piece is equity. The owner's claim after all the debts are paid.
Right. What's left over. And this section can have different flavors of stock preferred, common, treasury stock, which is shares bought back.
Ah, okay.
Additional paid-in capital, that's money from selling stock above its par value. Accumulated other comprehensive income, or AOCI.
That's the step that bypasses the income statement.
Kind of, yeah. Certain gains and losses. Then retained earnings, the profits kept in the business. And finally, non-controlling interests.
Non-controlling interest. Like if a parent company doesn't own 100% of a subsidiary.
Exactly. If they own, say, 80% of a smaller company, the other 20% equity stake belonging to someone else shows up here on the consolidated balance sheet. It reminds you the parent doesn't own it all.
Gotcha. And this sample, it has lots of notes reference, right? For things like restricted cash, fair value, doubtful accounts.
Yes, very helpful. And each note reference points to a chapter in the FST guide, implying, you can dig much deeper into any of those specific areas if you need to.
Plus, it's like a starting point for more detail.
Precisely.
Yeah.
Like, it highlights that SX 502 says you have to clearly show any legally restricted cash, maybe like compensating balances for a loan, and explain it in the notes.
Okay.
And another rule, ASC 825, requires separating financial assets and liabilities based on how they're measured fair value, amortized costs, etc. That affects how you read their value.
And receivables and payables need detailed breakdowns too.
Under SX 502, often yes. Separating what's owed by regular customers versus related parties or banks versus suppliers, you can sometimes show allowances, like for doubtful accounts, right on the balance sheet or disclose them in a note instead.
Seems like a lot of detail required, especially for things like leasing you mentioned.
Yeah, both the old and new lease accounting standards, ASC 840 and 842, have specific rules on presenting the net investment in leases for lessors. It's about transparency.
Right.
And deferred taxes, again, S6502 wants a specific breakdown. Remember, that's about future tax obligations, not current cash.
And depreciation, that cumulative wear and tear figure.
Accumulated depreciation, yes. SX502 says you can show it on the balance sheet, usually reducing the related asset's value, or disclose it in a note. And interestingly, under the older lease rules, ASC 840, capital lease assets could actually be lumped in with owned assets.
Oh, okay.
And goodwill, that definitely needs its own line item per ASC 350.
What about commitments and contingencies, like potential lawsuits?
Good question. Even if the amount on the balance sheet is zero, if there's a footnote discussing those potential obligations, SX 502 says you still need a line item for commitments and contingencies.
Wow, okay. Even at zero.
Yep. And for redeemable preferred stock, sometimes called mezzanine equity.
Kind of between debt and equity.
Exactly. SX 502 requires each separate issue to be shown individually if it's relevant. And additional paid-in capital can often be combined with the stock it relates to.
Okay.
Finally, retained earnings, the company's accumulated profit. SX 502 even specifies breaking that down between amounts set aside for specific purposes, appropriated, and amounts freely available, unappropriated.
So much detail. It's all designed for clarity, I guess.
Ultimately, yes.
Yeah.
These general presentation requirements aim for comparability between companies. That's a big goal.
And part of that is showing multiple years, right?
Yeah.
You mentioned the 2-year requirement for SEC companies.
Yes, that comparative view is mandated by the SEC. Under GAAP itself, for private companies, just showing 1 year is technically okay, but comparative data, usually 2 years, is strongly encouraged. It's desirable, as they say.
Because it shows trends.
Exactly. Are current liabilities growing faster than current assets? Is inventory piling up? You spot those things by comparing periods.
And the order earliest year first or latest year first. Does it matter?
SAB Topic 11E says there's no strict rule on the order itself. But, and this is key, consistency is required. Once a company picks an order, say, latest year first, they have to stick with it within that filing.
For everything in that report.
Right. And while that's an SEC rule, it's just good practice for everyone to be consistent. Makes it easier to follow.
Makes sense. Now, what about those significance thresholds? You mentioned certain balances have to be shown separately if they're big enough.
Ah, yes. The SX 502 connotative thresholds for SEC registrants. If an individual current asset or current liability is more than 5% of the total in its category, it generally needs its own line.
5%. Yeah.
For other assets, it's 5% of total assets. And there are specific rules for receivables and intangibles, too. For other liabilities, it's 5% of total liabilities.
So things like accrued interest or the current part of long-term debt often hit these levels.
So very often, yes. They're frequently significant enough to warrant separate presentation.
Okay. Now let's circle back to the classified balance sheet.
Yeah.
You said it's mandated by SX 502 and most companies use it. Why is that classification so important?
It's incredibly useful because it splits assets and liabilities into current and non-current. This lets you easily calculate and analyze a company's working capital.
Which is current assets minus current liabilities.
Exactly. And working capital gives you a real insight into the company's liquidity, its ability to meet short-term obligations. It's a key measure of near-term financial health.
So seeing that split helps you gauge if they have enough ready resources to cover upcoming bills.
Precisely. A big deficit in working capital could be a red flag.
So what's the official definition of current then?
Well, the ASC Master Glossary defines current assets as cash, and other assets expected to be turned into cash, sold, or used up within the company's normal operating cycle.
Okay.
And current liabilities are debts expected to be paid using those current assets, or by creating new current liabilities, again, within that operating cycle. Both FASB and the SEC use this operating cycle concept as the benchmark.
Right, the operating cycle. We mentioned it earlier. Can you define that more clearly?
Sure. Simply put, it's the time it takes a business to go from spending cash on materials or inventory to selling the resulting product or service and finally collecting the cash back from the customer.
So cash to inventory to receivables and back to cash.
That's the gist of it. Now, for many companies, they just use a standard 12-month period as a proxy for this cycle when classifying things as current or non-current.
But it should be based on the actual business cycle.
Ideally, yes. The specific business's cycle governs. Some industries, like tobacco aging or distilleries or lumber operations, might naturally have cycles longer than a year.
So they could classify something as current even if it takes 18 months to convert to cash.
If their normal operating cycle is 18 months, then yes. The guide actually has a figure, FSP 22, summarizing this time period determination.
Okay.
But keep in mind, some items have their own specific classification rules that might trump the operating cycle deferred taxes, or an example we keep coming back to.
Right. And not everything gets split, like property, plant, and equipment.
Correct. PP&E is typically all non-current. Depreciation is just allocating its cost over time, not converting the whole asset to cash within one cycle. Same for most intangibles.
Got it. Okay, shifting gears slightly, offsetting. Presenting assets and liabilities net of each other. When is that allowed?
Yeah, offsetting is pretty restricted. ASC 210-2045-1 says you can only present a net amount if a specific right of set-off exists and 4 criteria are met.
4 criteria. What are they?
Okay, first, each party owes the other determinable amounts. Second, the reporting company has the right to set off what it owes against what it's owed. Third, the company intends to set off. And fourth, that right is legally enforceable.
So like if I owe you $100 and you owe me $80 and we need all those conditions, I can just show a net payable of $20.
Potentially, yes. If the right exists, you intend to do it, and it's legal. It stops you from inflating both assets and liabilities on the face of the balance sheet.
That intent part seems a bit subjective, though.
It can be. But the guidance suggests looking at past practices. If a company usually settles these types of balances net and says it plans to continue, that supports the intent. But you can't offset if you don't actually plan to do it, even if the right exists.
And even if you do offset on the balance sheet.
You still need to disclose the gross amounts, usually in the footnotes, transparency again. And this offsetting rule doesn't mean you can net, say, debt against funds set aside in a sinking fund to pay it off later. That's not offsetting.
Okay, clear distinction. Now, what about non-controlling interests, NCI? We touched on it, the part of a subsidiary not owned by the parent. Where does that sit?
Right. NCI has to be shown as a separate component within stockholders' equity on the consolidated balance sheet. It needs to be clearly distinct from the parent company's own equity.
So it's part of equity, but flagged separately.
Exactly. And if a company has multiple subsidiaries with NCIs, they can often just aggregate them into one line item. Now, there are rare cases where NCI might end up outside of equity, maybe classified as mezzanine equity or even a liability. The guide points to specific literature for those exceptions.
Like the redeemable preferred stock situation.
Similar idea, yeah. And if NCI is outside equity, it triggers extra disclosure requirements, much like redeemable preferred stock.
Good to know those exceptions exist.
Yeah.
So we've covered a lot of ground, especially SEC rules. What about private companies? Any major differences we should highlight again?
Sure. While the basics are the same, there are key distinctions. That SEC rule on mezzanine equity presentation. Technically only mandatory for SEC registrants, but strongly encouraged for everyone for clarity.
Right. Best practice, even if not required.
Exactly. Also, the mandatory 2-year comparative balance sheet, that's an SEC thing. Private companies can just show 1 year under cap, although, again, comparative is preferred.
Makes sense.
And finally, those specific 5% thresholds from SX 502 for deciding if an account balance needs its own line. Those quantitative tests don't apply to private companies. They still need to present things clearly, but don't have those hard percentage cutoffs.
Okay, that's a really helpful recap of the private company perspective. So wrapping up, the big takeaway is that the balance sheet isn't just numbers, it's a structured snapshot, right?
Absolutely. A snapshot of financial position at a point in time, governed by rules designed to make it transparent and comparable.
We've hit the main building blocks: assets, liabilities, equity, classification, offsetting, NCI, public versus private nuances.
Yeah, I think we've covered the fundamentals needed to start making sense of it. It lays the groundwork for really understanding a company's financial structure and health.
It really does. And on that note, thinking of this financial photograph, here's something for you, our listener, to consider. What kinds of stories or trends might you start looking for when you compare balance sheets over time? Or maybe when you compare balance sheets of different companies in the same sector? It really transforms from just data into an analytical tool once you grasp these elements.
Good question.
We definitely encourage you to explore those ASC sections and FSB chapters we mentioned if you want to go even deeper. This has been a great starting point, though, for navigating this absolutely critical financial statement.